Ralph Lauren should be untouchable. This American luxury fashion company is sitting on a 60% stock surge, hitting all-time highs while competitors crumble, commanding 70% price increases that customers gladly pay, and somehow making 86-year-old Ralph himself cooler than ever with Gen Z on TikTok. But beneath this glittering surface, cracks are forming that could shatter everything. Let's start with what makes Ralph Lauren seemingly bulletproof. The numbers are staggering. Revenue hit $7.08 billion in fiscal 2025, jumping nearly 7%. The first quarter of 2026 delivered earnings per share of $3.52 per share, a 35% surge that crushed analyst expectations. Trading under the New York Stock Exchange ticker RL, the stock climbed 63% over the past year, while the broader market managed just 12%. When Ralph Lauren reached an all-time high of $383.98 in February 2026, it was not luck. It was the culmination of a masterclass in brand elevation. This company has convinced consumers to absorb price increases of over 70% since 2018. Think about that for a moment. In an era where every retailer fears losing price-sensitive customers, Ralph Lauren customers line up to pay more, much more. The average polo shirt that cost $85 in 2018 now commands $145, and stores are busier than ever. The brand's resurgence among Gen Z digital native consumers is nothing short of miraculous. On TikTok, Ralph Lauren Christmas searches exploded 600% in 2024, driving $6 million in brand value during the holiday season alone. The iconic polo bear sweaters went viral, spawning hashtags such as #DressingLikeAPoloBear and transforming a 50-year-old brand into the epitome of quiet luxury. According to the Harris poll, Polo Ralph Lauren saw a 6.5-point boost in brand equity among Gen Z adults, with quality scores jumping 13 points. This isn't accidental. While other heritage brands desperately chase trends, Ralph Lauren stayed true to its DNA. The preppy Americana aesthetic that Jerry Lauren named Polo in 1967, conjuring images of British society, exclusivity, and patrician style, has become the antithesis to fast fashion's disposability. Gen Z, exhausted by constant trend cycles, embraced Ralph Lauren's timeless approach. The company has successfully positioned itself in the accessible luxury tier, competing with brands like Tommy Hilfiger and Calvin Klein, while riding the wave of quiet luxury popularized by ultra-premium brands like The Row and Brunello Cucinelli. The company's operational excellence deserves recognition too. CEO Patrice Louvet, who took over in 2017 after a disastrous transition period, methodically diversified the supply chain across 5 continents. No single country accounts for more than 20% of production. China, once a major source, now represents only a high single-digit percentage. This foresight pays dividends as tariff concerns mount. When other fashion companies panic about trade disruptions, Ralph Lauren simply shifts production to Vietnam, Cambodia, or Italy. Digital transformation has been equally impressive. E-commerce sales jumped 34% in recent quarters, with digital channels representing a growing share of revenues. The company opened 34 new stores in fiscal 2025, strategically placed in markets like Hong Kong, Beijing, and London, while renovating flagship locations to maintain brand prestige. But here's where the fairy tale gets complicated. Ralph Lauren is 86 years old. This is not just an aging chief executive officer issue. This is an existential threat to a brand that is its founder. Consider the company's track record with succession planning. In September 2015, Ralph stepped down as chief executive officer, handing control to Stefan Larsson, a former H&M executive brought in to modernize operations. The marriage lasted 18 months. Larsson departed in May 2017 after disagreements over the company's turnaround strategy, corporate speak for Ralph refusing to let go of creative control. Ralph's memo to employees was telling. He wrote, "I am not stepping down, nor am I stepping back. I am stepping up." Today, Patrice Louvet runs day-to-day operations while Ralph Lauren remains executive chairman and chief creative officer. But what happens when Ralph is truly gone? David Lauren, his son and current chief innovation officer, represents one path forward, but replacing a founder whose personal aesthetic vision built an empire worth $7 billion is nearly impossible. Ralph Lauren is not just the company's name, it is the soul of every collection, every store design, every brand decision. Wall Street recognizes this vulnerability. Morningstar analyst Paul Swinand noted that Ralph's age was not unnoticed by investors, calling succession planning a natural part of the company's life cycle. The question is not if this transition will happen, but when and whether the brand can survive it intact. Unlike conglomerate-owned luxury brands under LVMH or Kering, Ralph Lauren's independence means there is no parent company safety net for major transitions. Beyond succession lurks a more immediate threat: the company's supply chain controversies. In 2024, an Ottawa corporate watchdog launched an investigation into Ralph Lauren over alleged forced labor in its supply chains. 2 vendors were accused of purchasing Xinjiang cotton through intermediaries or of cooperating in worker transfers that were subject to forced labor. This followed a damning 2025 BBC report about an Indian factory supplying Ralph Lauren, where women were allegedly forced to stay overnight and to work additional hours without notice, creating what workers described as a culture of fear. These investigations come amid increased enforcement of the Uyghur Forced Labor Prevention Act. These are not isolated incidents. Ralph Lauren scored just 14% on the 2018 Fashion Transparency Index and has consistently received low ratings for identifying forced labor in its supply chains. The company never signed the Bangladesh Accord or the Alliance for Worker Safety, drawing criticism from labor rights advocates. When you are charging premium prices for ethical luxury, these revelations are brand poison from an ESG perspective. Economic headwinds are mounting too. Chief Financial Officer Justin Pacici warned that the company would take a more cautious view of the second half of the year based on macro indicators, especially tariffs, weakening consumer confidence in the United States, and an increased risk of a broader consumer pullback. Even with supply chain diversification, a global economic slowdown threatens the discretionary spending that luxury brands depend on. China presents a particular challenge. The country's sluggish economy clouds what was once a promising growth market. While Ralph Lauren reduced dependence on Chinese manufacturing, Chinese consumers remain crucial to luxury sales worldwide. Any significant downturn there ripples through the entire industry. The valuation question is also becoming harder to ignore. At 24 times forward earnings, some analysts suggest Ralph Lauren stock may be pricey relative to fundamentals. The 60% surge has been spectacular, but it has also created expectations that may be difficult to maintain. When a stock climbs this far, this fast, any disappointment gets punished severely. Competition is intensifying as well. While Ralph Lauren benefits from the quiet luxury trend, other heritage brands are fighting back. Burberry, despite its own struggles, remains a formidable competitor. Tommy Hilfiger and Calvin Klein leverage similar Americana themes. Even fast fashion giants like Zara are launching premium lines targeting the same affluent customers. There is also the fundamental tension between exclusivity and growth. Ralph Lauren built its mystique on scarcity and aspiration. But public companies need constant growth, which often means broader distribution, lower prices, or brand extensions that dilute the core proposition. Louvet has spoken about reaching $10 billion in revenue, but can Ralph Lauren scale without losing what makes it special? The next few years will determine whether Ralph Lauren emerges as a truly timeless luxury powerhouse or becomes another cautionary tale about the perils of founder dependence. The financial metrics are undeniably strong. The brand momentum is real. But the structural vulnerabilities, succession uncertainty, supply chain controversies, economic headwinds, and valuation concerns create a perfect storm scenario. Ralph Lauren should be untouchable. The brand's cultural relevance, financial performance, and operational excellence suggest an unstoppable force. But something is breaking beneath the surface. Whether it is the inevitable transition beyond Ralph himself, the mounting ethical controversies, or simply the impossibility of sustaining such explosive growth, cracks are forming in what appeared to be an unshakable foundation. The American dream that Ralph Lauren built from a single drawer in the Empire State Building faces its greatest test yet. The question is not whether challenges exist. They always have. The question is whether this 57-year-old empire can navigate them without losing the magic that made Ralph Lauren legendary in the first place.